Welcome to Seminar 3, Accounting Analysis. What can we learn from a company's financial statements? Are these statements likely to inform us, or can they be used to try and mislead us? Or a bit of both? This week, we're considering the second item in our analytical toolkit, accounting analysis. I've kept saying that this is the extent to which the financial statements do a good or a bad job of reflecting the underlying economics of the business. We considered last week business strategy analysis. How does the business make money? This week we need to know about how well the business strategy and its effectiveness or otherwise are reflected in the financial statements. Accounting quality will mean different things to different financial statement users. As an investor, it might mean accounting that helps me with investment decisions. As a lender, it might be accounting that takes a conservative approach, that is, to reduce revenue and asset measurement to best protect me from potential loss. Earnings quality is a subset of accounting quality. Broadly speaking, it considers the extent to which earnings, net income, or some other measure on the income statement, like operating profit before tax, reflects the underlying performance of the business. Have a look at the earnings quality document on Moodle. You'll see a whole bunch of ways that CFOs define earnings quality. Some of these are related to each other, but the important point is that there is no one standard definition. So what explains variation in accounting quality? There are a number of factors. First up, let's consider the accounting rules. You should know from your introductory accounting classes that listed companies are required to use accrual accounting as opposed to cash accounting. You should know that the difference between the two systems of accounting is that accrual accounting recognizes revenues and expenses when they are earned or incurred respectively, and that this does not need to coincide with the inflow and outflow of cash. It also allows firms to record assets and liabilities on the basis of future receipts or payments of cash or other economic benefit. In other words, accrual accounting modifies cash flows. In particular, accrual accounting modifies cash flows to come up with a different measure of performance than net cash flows. It might be useful to examine whether this modified performance measure does a better job of capturing underlying economic performance than net cash flows. We often hear in finance that you can't trust the accounting numbers because the accrual process allows managers to use their discretion, and that you therefore should only use cash flows. Thought experiment. How might you measure whether or not net income is a better or worse performance measure than cash flows? So the accrual process requires managers to make estimates about the future, be it when they will collect accounts receivables, about how long they will use their equipment, and about how much long service leave they will need to pay. Is this good or bad? Well, the people running the firm, that is the managers, are hopefully in the best position to know these things. So managers' accrual estimations or decisions therefore have the potential to be informative to us. On the other hand, if managers know more than we do as outsiders, then they could use their discretion to try and mislead users of financial statements. Now, why would they try to mislead? Or to put it more formally, what incentives might managers face to deliberately mislead users of the financial statements? As an aside, I mentioned earlier that managers need to make estimates about the future under accrual accounting. They won't get these estimates exactly right. This introduces what we describe as noise into the accounting process. However, we would expect that over time that these errors would even out. That is, some would lead to income being too high and some lead to income being too low. This noise from estimates is different to managers trying to bias the reported accounting numbers in a particular direction. We can categorize some of these incentives into two broad buckets: market-based incentives and contractual incentives. I'll discuss each of these in turn. Market-based incentives relate to the way in which accounting numbers influence a company's share price. Managers would generally, but not always, prefer a higher share price than a lower share price. To the extent that managers think that earnings will influence share price, managers might face incentives to report better rather than worse earnings performance. If the firm is followed by security analysts, these managers will typically try to report earnings that beat the analyst's forecasts. We know that firms can suffer share price declines if they fail to meet analyst forecasts. We'll come back to this point later in the term when we consider the role of security analysts in more detail. Managers might also try to use their discretion to smooth out volatility in earnings. We know that investors and analysts prefer a smooth pattern of earnings, as this makes the valuation task easier. The other set of incentives that could influence reported performance are contractual incentives. Have a look at the bonus schemes that your key managers are under. Do these managers receive more pay if they achieve particular earnings-based targets? You'll find a lot of information about short and long-term incentive programs in the annual report. Your firm might also have loan agreements in place where the borrowing firm agrees to maintain certain financial statement-based ratios. For example, the firm might have to ensure that interest coverage remains above a particular number or leverage does not exceed a specified level. These covenants provide strong incentives for managers. It is usually the case that breaching these terms is defined an event of default under the loan. This then results in the firm having to renegotiate the loan, which can be costly in terms of managerial time as well as an interest rate penalty. In some cases, the accounting rules mean that it is hard for managers to show the underlying business performance. Take, for example, a rule that says that you must expense all research and development activity in the period in which it has occurred. This is the case in the United States. A rule like this means that regardless of whether or not the R&D expenditure gives rise to future revenues, it gets recorded as an expense. The alternative is allowing firms to defer the expenditure or to create an asset, as is the case for the development expenditure under the IFRS rules. The potential problem for expense all R&D rule is that it does not allow firms doing good R&D to distinguish themselves from firms doing bad R&D. Note that there are other ways that firms can communicate with their shareholders. You'll see other examples of these sorts of rules in the lecture notes. As an analyst, your role in assessing accounting quality can follow the following steps. First, you need to identify the key accounting policies of your firm. This means you need to focus on the 2 or 3 policies that are most critical for your firm and its business operations. This will vary, particularly by industry. For example, key success factors in the banking industry include interest and credit risk management. However, in the retail industry, inventory management is a key success factor. For the key accounting policies, you then assess the extent to which your firm has any accounting discretion or flexibility. To do this well, you need to know the relevant accounting rules for the key policies. For example, should your firm treat their research and development as expenditure or not? You can easily find the accounting rules online. You are then in a position to evaluate the accounting strategy, that is, the way in which managers choose to exercise their discretion in accounting. Does your firm adopt similar accounting choices to other firms in the industry? Do you see any evidence that your firm is systematically trying to bias its reported performance in a particular manner? As part of your accounting analysis, you should examine the extent to which your company explains its accounting policies and choices, and especially those choices that depart from industry norms. These disclosures can be found in the notes to the financial statements, as well as in other investor communications. Finally, you would assess the extent to which your firm has any red flags or indicators of questionable accounting. We've provided you with a list of things that CFOs consider to be red flags when they assess earnings quality. Chief among them is earnings that do not correlate with cash flows. So examine carefully situations where earnings are going up, but operating cash flows are declining. Also pay attention to accounting choices or earnings patterns that deviate from companies' peer groups or industry. If you're running a firm and you think that the accounting rules don't allow you to communicate your performance properly, there are plenty of CEOs who do think that, then non-GAAP or pro-forma earnings are an option. They have been increasing in their frequency over time. The adjustments made in non-GAAP earnings are not always income increasing. In my research on the use of non-GAAP earnings in Australia, we've found that pro forma figure exceeds the corresponding GAAP earnings metric about 60% of the time, which is a much lower level than we were expecting. Other researchers found that, on average, non-GAAP earnings are more informative rather than misleading from an investor perspective. That is, the stock returns for a company correspond more closely to the non-GAAP earnings than the GAAP earnings. If you think that your firm is not reflecting the underlying economics in their financial statements, then as an analyst, you can undo any distortions. For example, you can reduce the value of overstated assets or increase the value of understated liabilities. You can adjust for accounting rules that require firms to expense all relevant R&D. We'll go through some specific examples of these in the online seminar. Finally, your accounting analysis could involve the recasting of financial statements. This is a way of standardizing the financial statements so that they can easily be compared over time and also with peer companies. It's the sort of thing that you see done in the FactSet data, for example. Again, we'll go through some of this in our online seminar and preparation for your weekly hand-ins. So, in summary, accounting analysis considers the extent to which the financial statements do a good or a bad job of reflecting the underlying economics of the business. You consider the role of the accounting rules and the discretion that these rules give firms and their managers. You'll also consider the incentives that your firms face in reporting performance. Look for red flags in the way in which your company does its accounting and assess the accompanying disclosures. Finally, you can adjust the reported numbers to better reflect what you believe would be an appropriate accounting. All of this then leads into our next analytical step, financial analysis. By having a strong understanding of the firm and the way in which it reports, you will be better placed to assess recent financial performance and then to subsequently forecast future performance. We look forward to seeing you in class this week.